While you were focused on Federal Reserve announcements and domestic economic data, something significant was developing across the Pacific. Japan faces a difficult situation. The yen has weakened substantially against the dollar, reaching multi-decade lows at points. This weakness creates domestic inflation pressure in a country that imports much of its energy and food. To defend the yen, Japanese authorities have limited options. One option is selling dollar-denominated assets and buying yen. The largest dollar-denominated asset Japan holds? US Treasury securities. According to market analysis, Japan may have conducted significant currency intervention operations in recent periods. These interventions appear to coincide with Treasury sales. The dynamic creates a potential feedback loop. Japanese selling of treasuries could contribute to higher US interest rates, which could strengthen the dollar further, which could weaken the yen more, which could require more intervention. Your mortgage rate, your credit card interest, your car loan payment. These are all influenced by treasury yields. When the largest foreign holder of treasuries becomes a seller rather than a buyer, the supply-demand balance in the world's most important bond market shifts. And that shift affects everyone who borrows money in dollars. Now, let me be very precise about sources and methodology before we continue. I'm drawing from Treasury International Capital reports, which track foreign holdings of U.S. securities, from Bank of Japan policy statements, from Japanese Ministry of Finance intervention disclosures, from Federal Reserve data, from academic research on currency intervention mechanics. These are official sources, government publications, central bank communications. What I'm presenting is documented data and historical patterns. I'm not predicting specific outcomes or timing. I'm analyzing what appears to be happening, what has historically happened in similar situations, and what the range of potential implications might include. Markets are complex. Causation is difficult to establish definitively. I'll be careful to distinguish between what we know, what we can reasonably infer, and what remains uncertain. By the end of this video, you'll understand exactly what Japan's treasury position means for global markets, what historical precedent tells us about major foreign holder selling, and what range of outcomes the current situation might produce. Because here's what most people don't realize. This is not the first time a major foreign holder has significantly reduced treasury exposure. There's historical precedent we can examine. There's a documented pattern here. A pattern where major creditor nations, facing their own economic pressures, reduce holdings of debtor nation securities. The debtor nation then faces higher borrowing costs. The adjustment process can be gradual or disruptive depending on circumstances. Same dynamic across different eras. Same basic mechanics. Different specific outcomes depending on policy responses. The Japan-US Treasury relationship represents one of the most important financial linkages in the global economy. Understanding what's happening in this relationship provides insight into forces that will influence interest rates, currency values, and investment returns for years to come. Stay with me. The next 15 minutes will illuminate dynamics that most financial coverage overlooks. To understand what Japan's treasury selling might mean, you need to understand how foreign treasury holdings have historically functioned and what happens when major holders become sellers. The foreign holding of U.S. treasuries operates through a specific framework, the recycling mechanism. Countries that run trade surpluses with America accumulate dollars. Those dollars need to be invested somewhere. U.S. treasuries offer safety, liquidity, and yield. For decades, surplus nations recycled their dollars into treasury purchases. This recycling kept treasury yields lower than they otherwise would have been. Foreign demand supplemented domestic demand, allowing the U.S. government to borrow at favorable rates. Japan and China together have historically held approximately $2 trillion in treasuries. That's $2 trillion in demand for U.S. government debt that didn't have to come from domestic sources. The reversal dynamic. When foreign holders become sellers rather than buyers, the dynamic reverses. The Treasury must find alternative buyers for new issuance plus the securities foreign holders are selling. Alternative buyers typically demand higher yields. More supply meeting, less demand equals higher interest rates, all else equal. The adjustment can be gradual if selling is measured and alternative demand emerges. Or it can be disruptive if selling is rapid and markets must absorb large volumes quickly. The feedback loops. Foreign selling can trigger feedback effects. Higher treasury yields can strengthen the dollar. A stronger dollar can pressure foreign currencies. Pressure on foreign currencies can create domestic inflation in foreign nations. That inflation pressure can motivate more selling to defend currencies. The loops can be stabilizing or destabilizing depending on policy responses and market conditions. Now let me show you historical examples of major foreign holder adjustments. 3 examples, 3 different contexts, important lessons from each. 2015 to 2016, China's treasury reduction. This example matters because it represents the most significant recent reduction in treasury holdings by a major foreign holder, and because it demonstrates both the potential impact and the limits of that impact. In 2014, China held approximately $1.3 trillion in US Treasuries, the largest foreign holder at that time. The Chinese economy was slowing. Capital was flowing out of China. The yuan was under pressure. To defend the yuan, Chinese authorities sold dollar assets and bought yuan. Treasury holdings declined from approximately $1.3 trillion to under $1.1 trillion over roughly 18 months, a reduction of over $200 billion. What happened to Treasury markets? Treasury yields were volatile during this period, but didn't spike dramatically. The Federal Reserve was maintaining accommodative policy. Other buyers absorbed Chinese selling. The adjustment was manageable. But the experience revealed important dynamics. First, the scale of potential selling was significant. $200 billion represented substantial supply entering the market. Second, the selling was related to currency defense. China wasn't selling because it lost faith in treasuries. It was selling because it needed dollars to buy yuan. Third, alternative demand matters enormously. The Fed's policy stance and other investor behavior offset Chinese selling. The lesson: major foreign holder selling is absorbable under favorable conditions. But conditions aren't always favorable. Pattern identified. Currency pressure can trigger treasury selling. Outcomes depend on broader conditions. 2022 to present. The coordinated foreign reduction. This example matters because it's happening now and because the context differs significantly from 2015. According to Treasury International Capital data, multiple major foreign holders have reduced treasury positions since 2022. China has continued reducing holdings. Japan's holdings have declined from peak levels. Other nations have adjusted positions. Meanwhile, the Federal Reserve shifted from buyer to seller. Quantitative tightening means the Fed is reducing its treasury holdings rather than adding to them. The combination of foreign selling and Fed selling created a significant shift in treasury market dynamics. What happened to treasury markets? Treasury yields rose dramatically. The 10-year yield went from approximately 1.5% in late 2021 to over 5% at points in 2023. The 30-year yield showed similar movements. Was foreign selling the only cause? No. The Fed's rate increases were the primary driver. Domestic inflation expectations mattered. Fiscal deficits mattered. But foreign selling occurred simultaneously with these other factors. The reduction in foreign demand coincided with the largest treasury yield increase in decades. Correlation doesn't prove causation, but the timing is notable. The lesson: when multiple factors align, Fed tightening, foreign selling, fiscal expansion, the impact on treasury yields can be substantial. The current environment includes all three factors. Pattern confirmed. Multiple selling pressures can compound. Current conditions include multiple pressures: Japan's domestic banking crisis and treasury dynamics. This example matters because it shows how Japanese domestic financial stress can influence treasury holdings, and because the current Japanese situation involves domestic policy stress. In 1997 and 1998, Japan faced a severe banking crisis. Major financial institutions failed. The government undertook massive interventions. The yen experienced significant volatility. Japanese institutions, facing domestic capital needs, became less aggressive treasury buyers. Some institutions sold foreign assets to meet domestic obligations. The impact on treasury markets was moderated by other factors. The Asian financial crisis drove flight to safety flows into treasuries. The Fed cut rates. Russian default created additional treasury demand. But the episode demonstrated that Japanese domestic stress can influence treasury holdings. When Japanese institutions face capital constraints, their foreign asset positions become sources of liquidity. Fast forward to today. The Bank of Japan has maintained extraordinarily accommodative policy while other central banks tightened. Japanese government bonds have lost value as yields rose slightly. Japanese banks hold substantial government bond positions with unrealized losses. The situation is not identical to 1998, but the dynamic, domestic financial stress potentially influencing foreign asset positions, has historical precedent. The lesson: Japanese domestic conditions matter for treasury markets. Japan isn't just a passive holder, it's an active participant whose domestic situation influences its treasury position. 3 examples. Each demonstrates different aspects of the Japan-Treasury relationship. Each offers lessons for interpreting current developments. Now let me analyze what's happening currently and what the range of potential implications might include. Current Japanese Treasury holdings. According to Treasury International Capital data, Japanese holdings have declined from peak levels. The reduction has occurred over an extended period but appears to have accelerated in recent months based on available data. The total position remains over $1 trillion, making Japan the largest foreign holder. But the direction of change matters as much as the absolute level. Why Japan appears to be selling. Several factors likely contribute. First, currency intervention. The yen's weakness has prompted intervention to support the currency. Selling dollars, including dollar assets, and buying yen is the mechanical intervention process. Second, Yield differentials. Japanese investors holding treasuries face currency hedging costs that can exceed the yield earned. Hedged returns may be negative, reducing the attractiveness of treasury holdings. Third, domestic needs. Japanese institutions may need capital for domestic purposes as the Bank of Japan adjusts policy and domestic bond prices adjust. Fourth, diversification. Like other nations, Japan may be diversifying reserves away from concentrated dollar exposure as a general risk management practice. The potential implications. If Japanese selling continues or accelerates, several implications are possible. Treasury yields could face upward pressure, all else equal. More supply meeting steady or reduced demand typically means higher prices for that supply. In bond terms, higher yields. The dollar could face mixed pressures. Intervention selling is bearish for the dollar against yen, but higher treasury yields can attract capital inflows that support the dollar. U.S. borrowing costs could rise. Government interest expense, already exceeding $1 trillion annually, could increase further. Other foreign holders might follow Japan's lead. Herd behavior in financial markets is well documented. If Japan sells, others may question their own exposure. The uncertainty. I want to be very clear about what we don't know. We don't know the pace of future Japanese selling. Policy decisions depend on factors we can't predict. We don't know how markets will absorb any selling. Alternative buyers may emerge. The Fed could adjust policy. Conditions can change. We don't know the ultimate economic impact. Markets are complex systems. Simple cause and effect predictions are often wrong. What we can say is that the direction of Japanese treasury holdings appears to have shifted. The largest foreign creditor appears to be reducing exposure. This represents a meaningful change in a relationship that has supported U.S. borrowing for decades. The range of potential outcomes spans from manageable adjustment to significant market disruption, depending on factors that remain uncertain. Now I know what some of you are thinking. Let me address the counter-arguments directly. But Japan can't really sell aggressively. They'd hurt themselves. There's truth here. Japan selling large treasury volumes would likely strengthen the yen dramatically, potentially overshooting their goals. And Japan holds treasuries partly for geopolitical reasons, the security alliance with America. But can't sell aggressively doesn't mean won't sell gradually. The question isn't whether Japan dumps everything overnight. It's whether the marginal buyer becomes a marginal seller and what that means over time. But the Fed can always buy what Japan sells. The Fed could resume quantitative easing and absorb treasury supply. They have that technical capability. But QE, during elevated inflation, risks reigniting price pressures. The Fed faces trade-offs. They may not choose to absorb foreign selling if doing so conflicts with inflation mandates. Policy capability and policy willingness are different things. But treasury markets are the deepest, most liquid in the world. True, treasuries are extraordinarily liquid. The market absorbs large transactions routinely. But liquidity isn't unlimited. During stress periods, even treasury markets experience disruption. March 2020 saw treasury market dysfunction requiring Fed intervention. October 2022 saw a UK gilt market crisis that spread to treasury markets. Depth and liquidity are advantages, not guarantees. But Japan is an ally. They wouldn't destabilize America. Japan's treasury decisions aren't about destabilizing America. They're about Japanese domestic needs. If yen weakness threatens Japanese price stability, Japanese authorities will prioritize Japanese citizens, as they should. Alliance relationships are real, but they don't override domestic economic imperatives. Japan will manage its reserves for Japanese interests, and that management may involve treasury reduction, regardless of alliance considerations. But this has been predicted before, and markets were fine. Previous predictions of treasury market crisis haven't materialized. The dollar remains dominant. Treasuries remain the global safe asset. But conditions change. The fiscal trajectory is worse than historical periods. The Fed is tightening rather than easing. Multiple foreign holders are reducing exposure simultaneously. Past resilience doesn't guarantee future resilience. And dismissing current developments because past predictions were wrong is its own form of analytical error. So what does this mean for you? Practically, specifically. Right now, I'm not a financial advisor. I'm not recommending any specific investments. I'm sharing analytical frameworks and observations that you can incorporate into your own thinking. First, understand the treasury market's importance. Treasury yields influence virtually every interest rate in the economy. Mortgages, corporate bonds, credit cards, auto loans, all are priced relative to treasury rates. What happens in treasury markets affects your borrowing costs, even if you never buy a treasury bond. Understanding treasury dynamics is foundational to understanding the economy. Second, recognize that the risk-free rate isn't risk-free. Treasuries are considered the risk-free asset because the U.S. government can always pay dollars by creating more dollars. Default risk is essentially zero, but interest rate risk is real. Treasury prices can decline significantly when yields rise. Long-duration bonds have experienced substantial losses since 2020, and currency risk exists for foreign holders. A Japanese institution holding treasuries faces yen-dollar exchange risk. Risk-free is a term of art, not a complete description of reality. Third, watch the data. Treasury International Capital reports are published monthly with a delay. They're available on the Treasury Department website. Watching foreign holder changes provides insight into global demand for U.S. debt. Major changes often precede market movements. Fourth, consider the fiscal dimension. The U.S. government is borrowing over $2 trillion annually. This supply must find buyers. Domestic savings, Fed purchases, and foreign purchases must collectively absorb issuance. If foreign demand weakens, either domestic demand must increase, likely requiring higher yields, or Fed purchases must resume, potentially inflationary, or fiscal deficits must shrink, politically difficult. The arithmetic is challenging. Understanding the challenge helps contextualize market developments. Fifth, maintain appropriate humility. I've presented analysis, not certainty. Markets are complex. Predictions are difficult. Smart analysts disagree about implications. Use this information as one input among many. Don't make dramatic portfolio changes based on any single analysis. Diversification and prudence remain appropriate regardless of macroeconomic views. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video examines which assets have historically performed best during Treasury market stress periods with data from multiple historical episodes. Drop a comment below. Tell me what you're seeing in global markets, whether you find this Treasury analysis concerning or overblown. What questions remain? I read every comment. This channel grows through engaged discussion with people who recognize that the most important economic developments often involve technical dynamics that headlines oversimplify. Here's what I want you to remember. Japan holds approximately $1.1 trillion in US Treasuries. That position appears to be declining. The decline coincides with yen weakness and apparent currency intervention. This represents a meaningful shift in a relationship that has supported US borrowing for decades. The largest foreign creditor appears to be becoming a seller rather than a buyer. The implications depend on many factors: the pace of selling, alternative buyer emergence, Fed policy, fiscal trajectory. The range of outcomes remains wide. What I can say with confidence is that this development warrants attention. The Treasury market is foundational to global finance. Changes in its supply-demand balance affect everyone. The data is public. The dynamics are observable. The uncertainty is real. Thanks for watching The Silent Economy. And remember, the people who navigate financial transitions successfully are not always the ones who predict precisely what happens. They're the ones who understand the forces at work and position prudently for a range of outcomes. The Treasury data is available. The analysis is here. The thinking is yours to do.